What are the pros and cons of incorporating your property portfolio? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Incorporating your property portfolio into a limited company can be a really great way of managing your taxes, managing things for the future, and helping to work through and maintain your property portfolio. However, there are some pros to it and there are some cons. And there is some things that you need to be thinking about based on what is the actual plan for the future. And this is always the first question I come back to. What is the end goal? What are you trying to achieve? If you've got children or a legacy, or you're looking at doing things for the future, then it may be you want to have things to pass on and minimize your inheritance tax. So there are different strategies by using companies to work through that. It may be you're thinking, I want the properties and at some point I'll sell them and that's my pension pot and that's what I'm going to use to live on. All of these considerations really are important and will determine what the best approach is for you in your property purchase adventure, and whether you should be purchasing things in your own name or whether you should be purchasing things through a limited company. Now, if you are looking at purchasing property in your own name, then any income or rental profits you get will be taxed at your tax rate in your own name, depending on what other income you've got. So if you are working a full-time job, you may have a 30,000 salary or a 60,000 salary or 100,000. Whatever you have will then determine where your rental profits go onto your tax return, which you will need to do, and what tax rate they are charged at, whether that be 20%, whether that be 40%, or whether that be 45%. So we see a lot of people then think, I'm going to go into a company because the tax is cheaper. And I can definitely confirm that the tax in a company is cheaper. So there are definite advantages of putting it into a company, depending what the goal of doing that is. Now, the reason I say what the goal of doing that is because if you are earning 100k and you're doing the property on the side for the future when you don't have that 100k income, then a company could be definitely the right option for you. However, if you're on 100k now and you're planning on taking that money out, then it may not even at this point be the right option. And the reason I say that it might not be the right option is because the company will be taxed at 19 or 25%, or the marginal rate in between. When you make the profits in the company, there is a tax charge to it. The secondary thing to remember and be aware of is when you take that money out of the company, there will also be a tax charge. And this again is dependent on your income in your own name. So if you're a basic rate taxpayer, it will be 8.75%. If you're a higher rate taxpayer, it will be 33.75%. And if you're an additional rate taxpayer, it will be 39.75%. So if you think about it there, if you're a higher rate taxpayer, you'll be paying 40% in your own name. If you're doing it through a company and then taking it all out, you'll be paying potentially 19 or 25% in the company, as well as then 33.75% to take that money out. So it's not actually 40% compared to 25%. It's actually 40% compared to 25 plus the 33%. So you're actually looking at 58% tax that you'll have paid on that income instead of just 40%. So if you are planning on taking all that money out of your company, then potentially the company may not be the perfect solution. Now, if you're looking at putting it in joint names with a spouse, for example, and they're only a basic rate taxpayer and you can take that money out and they're only paying 8.75%, then maybe if you're paying 19 and 8.75%, then you're actually only 27.75, which is cheaper than if you were taking it out in your name at 40%. So as you can see here, there are different nuances that you just have to watch for this double taxation, because the initial thought process for a lot of people is, oh, the tax in a company is cheaper. It is cheaper. However, when you're looking at drawing that money out, there is also a tax charge that you need to take into account. So if you're not wanting to be taxed on the whole balance, then yes, that might be good solution. If you're looking at drawing all of that profit out, then it's, are you going to be in a better position or not? So as you can see, it's very much dependent on what are you planning on doing. As we said, if you're putting it into the company and then it's pension pot for the future and you're going to draw on it when you've not got the same amount of income, then actually that would work amazingly. If you're wanting it now and needing it now, then actually that might not be the right solution for you. Moving on to your mortgage deductibility, and as hopefully you may have seen on the channel, there's quite a few videos on mortgage interest and how it works as an individual. And this is where arguably your rental profits get taxed, and then you'll get a 20% interest rate relief credit against your income. So on that basis, you will have a reduced tax amount, but you're only getting 20% tax relief on your rental mortgage expenses. Compared to a company where it's a company loan, so that loan will be allowable for tax purposes and you'll be getting 19 or 25% tax relief on that mortgage interest. Which kind of means whichever route you take, there is availability to reduce the cost of your tax with the mortgage interest. So a mortgage does have an impact on both ways, it's just taxed in a slightly different way from an individual over to a limited company. If you're a basic rate taxpayer, then it doesn't really make any difference. If you're a higher rate taxpayer, it does mean you are only limited to 20%, so you won't be getting a 40% tax deduction for it. But either way, it is helping reduce your tax bill. Moving on to the one that is the big one that I know I speak to a lot of clients about, which is inheritance tax. And the reason I talk to clients about inheritance tax is because they're planning for the future. They want to grow a property portfolio, but they want to also leave it to their children, and they don't want to find that they lose 40% of their portfolio because of inheritance tax. So one great way of moving things across is through a limited company, because you don't own the property in your name, you have shares in the company. And those shares in the company can be transferred over a period of time to your children over 20, 30 years. So progressively they own more of the portfolio and you reduce your estate progressively over a period of time. Now, if you go down the route of owning things in your own name, then that is not going to be possible in the same sort of way, because that means that you own the property and you will have to transfer part of the property or the whole of the property across. Now, either way, whether you own it in your own name and are transferring or whether you own shares in the company, there will be capital gains tax implications. However, those capital gains tax implications are a bit more manageable potentially with shares, because you can transfer 5% or 2% or 1% of shares. It's slightly more tricky if you're transferring part of a property and that side of things, and the legal process is a little more cumbersome because you are down to solicitors reporting to the land registry. With share transfers, it's share transfer forms, it's capital gains tax on your income tax returns, which is a little more straightforward because you're probably already going to be doing the income tax return anyway as an individual, and the share transfer forms are just some company's house forms that need to be filled to transfer those shares across, and an update on your confirmation statement when that's due following the transfer. So from a paperwork point of view, the transfer across is a lot easier on the limited company than it is on an individual basis. It kind of depends on the value of your portfolio and what you're planning on doing, again, to determine what is going to be the right solution for you and your family. As we discussed, double taxation is a real issue here, and again with capital gains tax and inheritance tax, there's always that risk that if something happens to you, there is a double taxation risk, that if you transfer some shares across or you transfer a property across, if it's done as a gift, so there's no consideration paid, they're not paying for it, you're gifting it across, there'll be capital gains tax implications. But also you need to be aware that if something happens to them within the 7-year period, then it does get brought back into inheritance tax, into the estate. So there may be a double taxation there, that you've transferred something across, paid the capital gains tax, then something's happened to them, they passed away, so that's within the 7 years, so now there's also inheritance tax on it, which kind of leads to say you need to be doing this planning well ahead of any point where anything's going to be happening to you. It's not a matter of getting to the tender age of 85 and thinking, right, I'm going to do everything now, and then unfortunately something happens and you lose your life 2-3 years later, and any transfers you've made, you've paid the tax, capital gains tax, and then you find that you're not around, unfortunately, but your family find that they're now paying inheritance tax on top of it. So as well as paying the 24% or the 18%, they're also paying potentially 40% or 32%, depending on where it's got to in the grand scheme of things, for the inheritance tax kind of fall down as the percentage reduces on the 7-year rule. But again, there is that risk of double taxation you need to be aware of, so that your planning is done sufficiently in advance to make sure that you are not going to find there's any adverse tax implications. If you're thinking of transferring existing properties into a company, then you just need to be aware that there are costs associated with this, and check out the video on transferring property to a company to see how that fits together, because you do need to be thinking about capital gains tax, you need to be thinking about early redemption charges, solicitors' fees, and also stamp duty. So you may need to just consider whether incorporating a portfolio in existence is the right move, or if you're starting out, it may be just consider, if you do get it in your own name and think about doing something later, be aware of the costs that are associated with making a change at a later point in time. In terms of going in a limited company compared to an individual, as an individual, obviously any rental income is reported on your income tax return, which means you've just got that form to do. There's no separate forms. I will highlight here that there is the Making Tax Digital that is approaching, and check out the videos on that to see what that's all about. But this will require quarterly reporting going forward, so you do just need to be aware that this is happening, as you will be brought into that at some point, which is meaning there is a little more compliance work than historically there has been for individuals. As a limited company, you'll have to register your limited company with Companies House. You'll have to do company accounts every 12 months, which are required to be filed 9 months after the year end, as well as you need to do a corporation tax return, which needs to be paid 9 months and a day after the year end, and then also the corporation tax return needs to be filed 12 months after the end of the accounting period. So from a compliance point of view, there is much more when you come to doing a limited company, and again, you'll find your accountancy fees for doing a personal tax return in the hundreds compared to limited company accounts, which are probably approaching £1,000 or more, depending on the size and scale of transactions that are going through that company. As well as this, if you're looking at taking money out of your company, you may need a payroll scheme if you're going to be taking salary, or there is dividend paperwork that needs to be done if you're taking things out as a dividend. So again, just another added layer of complication if you're going down a company route to be aware of. Obviously, from a practical point of view, there is also your bank account that you are going to have to open in your company name, which hopefully you've got a separate one in your own name if you're operating in that way at the present, or thinking of operating in that way at present. So there is just, again, added practical admin jobs that you need to do, that you just need to remember about to make sure that you are doing things in the right way. A final thing to mention in our overview of some of the pros, cons, things to be aware of if you're looking at incorporating your properties, then is the fact that if you are getting financing on any mortgages, that generally if you're going in a limited company, the cost of financing is a little bit more. It's not as significant as in the past, but it should be noted it is higher. So it may only be 0.5% or 1% higher, but again, it's all added costs as well as the added cost of running a company. So if you are only looking at 1 or 2 properties, there is a significant chance that, depending on your position and what your plans are, it may be worthwhile doing it in your own name. If you're looking at expanding a portfolio to a more significant level, then a company could be a great option because of all the other tax practical benefits that it also does have around it. So if you are thinking about going into a company or doing it in your own name, I'd definitely say speak to an advisor, have a chat through what you're looking at doing. And the big question you should always be asking yourself, which I do appreciate will change over time, is What is the long goal? What is the outcome? What is the end goal? Is this your pension pot? Is this something you're wanting to pass to children? Is it something you want to do for the next 5-10 years and then you'll be getting out of? Because all of these are very significant points, and depending what your approach is and what you're looking at doing with your property adventure, that will determine what the best option is for you, and whether going down a limited company route is right, or whether actually keeping things in your own name is the right option for you. Don't get led by the trend of everyone's getting a limited company. It may not be right for you, or it might be the perfect solution and exactly what you should be doing. Hopefully today you've discovered what may be the reasons you do and the reasons you don't for incorporating your property portfolio. If you do have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing.